Ladies and gentlemen, welcome to Nutshelled History. Now buckle up. Today we are diving into the thrilling world of hostile takeovers. That's right. The corporate equivalent of crashing a wedding and not only stealing the cake, but also marrying the groom or the bride. Or both if you are feeling especially ambitious. So what is a hostile takeover? It is when one company tries to acquire another company without the consent of that company's management or board of directors. In simpler terms, imagine walking up to someone and saying, "Hey, I'm going to own your house now." And when they say, "No thanks, I am not selling," you respond, "I wasn't asking." It is bold. It is dramatic. It is capitalism with a side of mischief. Now let's break down the reasons behind a hostile takeover. Why would anyone do that? Well, for starters, maybe the acquiring company thinks the target company is undervalued. Picture a beautiful vintage car sitting in someone's garage collecting dust. It is not being taken care of. The tires are flat, the radio still plays cassette tapes, but someone sees potential. They think with a little polish and a better driver, that car could be worth a fortune. So they make a move. Another reason is synergy. And no, that is not a trendy new yoga class. It is the idea that two companies combined can do more together than apart, like peanut butter and jelly, or more accurately, like peanut butter and Nutella. It gets messy, but delicious profits may await. Sometimes it is about eliminating the competition. The acquiring company wants to take out a rival before the rival grows too strong. This is the business version of, if you can't beat them, buy them, and then fire half of them. And occasionally it is just plain ego. A powerful CEO sees a company and thinks, "I could run that better." And then they try to prove it by buying the whole operation like it is a Monopoly game. So how does a hostile takeover actually happen? Glad you asked. There are a few main strategies and they each come with their own flair. Before we go on, don't forget to go nuts on those like and subscribe buttons for me and say something not so hostile in the comments down below. It really helps me out. Okay, first up is the tender offer. This is where the acquiring company goes directly to the shareholders of the target company and says, "Hi there. We know your board of directors said no, but we are willing to buy your shares for a nice premium over market value. What do you say?" It is like bribing the guests at a party to elect you as the new host. If enough shareholders agree, the acquiring company gets control whether management likes it or not. Next is the proxy fight. No, not a sword duel in the boardroom, though that would be wildly entertaining. A proxy fight is when the acquiring company tries to convince shareholders to vote out the current board of directors and replace them with people who are friendly to the takeover. Think of it as staging a peaceful coup with ballots instead of bullets. If successful, the new board members give the green light to the acquisition. There is also creeping acquisition, which sounds like a nature documentary, but is actually a strategy where the acquiring company slowly buys up shares over time until they have enough to gain control. It is subtle. It is sneaky. It is basically financial ninjutsu. Now, of course, the target company does not usually just roll over. There are defensive moves. You did not think this would be one-sided, did you? One classic defense is the poison pill. This sounds dramatic because it is. The company sets up rules that make it more expensive or difficult for the acquirer to complete the takeover. For example, allowing existing shareholders to buy more stock at a discount, which dilutes the value and makes the takeover more costly. It is like spiking your own punch so no one else wants to drink it. Another tactic is the white knight. This is when the target company finds a friendlier buyer to come in and rescue them from the hostile suitor. It is like dodging a terrible blind date by calling your attractive ex and pretending you are still together. Sometimes companies even take on debt or sell off key assets just to make themselves less attractive. It is kind of like smearing catsup on your shirt so no one asks you to prom. Hostile takeovers are dramatic, risky, and often expensive. They are not always successful either. Sometimes the acquiring company underestimates how hard it will be to take control. Other times, they succeed, but the acquisition turns into a money pit. And yet, these bold moves continue to happen. Because for some companies, the reward outweighs the risk. They see opportunity, they smell profit, and they have no problem pushing past a few closed doors to get it. To wrap up, a hostile takeover is essentially corporate romance with zero consent and a lot of lawyers. One company wants another, the other says no. And then a battle begins for control through money, persuasion, and occasionally outright shareholder warfare. So the next time you hear about a hostile takeover in the news, remember it is not just business. It is a boardroom soap opera starring spreadsheets, strategy, and some very determined executives. And remember, in the world of business, you do not always need an invitation to take over the party. Just enough cash, charm, and chutzpah. There you have it, folks. That is Hostile Takeovers Nutshelled. Thanks for stopping by Nutshelled History. Go crazy nuts on those like and subscribe buttons for me. Okay, I'll see y'all next time on Nutshelled History.